Hey everybody, it's Professor Williams, and in this video we're going to look at the difference between the book value of equity and the implied value of purchase price. So Brooks purchased 8,896 shares of Dunn's common stock for $131,000, and we're given the statement of financial position for the two companies immediately after the stock acquisition. What we're going to do is prepare a schedule to compute the difference between the book value of equity and the value implied by purchase price. The note here is that any difference between the two is going to relate to the subsidiary's plant assets. So first thing that I did was I calculated what my parent share and my non-controlling share were. We know that Dunn had $111,200 of common stock on the books at $10 par. So the $111,200 divided by par value tells me that they had 11,120 shares of stock outstanding, and they purchased 88.96 of them. So up here, what I did was I just said 8,896 shares that I purchased divided by the total of 11,120 outstanding gave me my 80%, and then the other 20% is their non-controlling. So we're going to begin with purchase price and implied value. So we see that on Brooks assets, they have the investment in Dunn Company of $131,000, and that's going to give me my total. So I'm going to take my 131 and I'm going to divide it by my 80% parent share, and that'll give me the 163,750 total purchase price and implied value. And now I'm going to split that between the parent by multiplying that by the 80%, and then I'm going to take it and multiply it by the 20% for the non-controlling share. Next thing I need to do is I need to allocate common stock. So if I look at the liabilities and owners' equity financial position of Dunn, we'll see that the common stock had a total value of $111,200. And again, I'm going to allocate that between parent and non-controlling. So I'm going to take my 111,200, multiply it by my 80% share, get my 20% non-controlling interest to allocate common stock. Other contributed capital located in the liability and equity portion under Dunn is a total of 15,650, and again I'm going to allocate that times 80%, and then I'm going to take the total contributed capital times the 20%. Going to do the same thing with retained earnings. I see on under Dunn I have 11,050 in retained earnings. I'm going to allocate that 80% to the parent share and then 20% to the non-controlling. So this allows us to get total book value, the sum of the stock, other contributed capital, and the retained earnings. So I get 110,320, and because I'm just going to add those across, I can get the total book value. Now I'm going to look at the difference between implied and book value. The implied value here minus my book value here will give me a difference of 2680. Here I take, for non-controlling, implied minus book, and then my total here. So what we know is that any difference between book and equity relates to subsidiary plant assets. And so what I need to do is I need to zero out that balance. And so my entry here is going to be number, whoops, times -1. This times a -1. And it gets me down to the zero balance that I needed. And I am done. I hope that you found this helpful, and thanks for watching.